The traditional corporate workplace has fractured over the past few years, leaving millions of square feet of once valuable real estate completely empty. This chart tracks paid workdays happening from home. It stabilized at 28%, and the workforce never went back. Consequently, the national office vacancy rate climbed alongside it, moving from roughly 17% in 2019 to record territory near 20% today. Record vacancy has created the very market current buyers were waiting for. Property values followed vacancy down, opening up a repriced basis trade. Every acquisition now hinges on a new financial basis and a specific plan, whether to reposition, release, or convert the asset. Previous office deals operated on wide equity margins. Today's acquisitions rely on deeply discounted basis trades to make the math work. This chart compares how a $300,000 legal defect affects those margins. At 2019 prices, that expense is an annoyance. At today's repriced basis, it is a meaningful fraction of your entire equity. A physical property tour or a broker's pro forma cannot confirm if the building is legally able to execute your business plan. The viability of your strategy lives entirely in the recorded instruments underneath the property: the garage agreements, the shared facility easements, and the legacy tenant rights. Discovering a restrictive covenant or a stranded parking allocation after the deed records instantly turns a promising repositioning plan into a legal trap. Re-leasing vacancy is the most common strategy. But while an apartment building spreads risk across hundreds of units, an office building concentrates its income in a handful of large anchor tenants. Those large tenants have outsized negotiating power. They often secure recorded expansion rights, options to extend, or rights of first refusal. A memorandum of lease recorded a decade ago can carry an expansion right over the exact floor your repositioning plan requires. That single instrument can stop a lucrative new anchor deal dead in its tracks. Even with clear floors, re-leasing requires constant construction. Every new lease brings a tenant build-out, and stressed sellers frequently leave those improvement allowances unfunded. In both Virginia and West Virginia, mechanics' liens relate back to when the construction work originally began, not when the claim is eventually filed. This look-back period means an unpaid contractor who finished work months before you even toured the property can perfect a lien after your deed records, stepping right in front of your priority. Securing tenant estoppels and mapping out recent lien waivers during the diligence period is the only reliable way to protect your capital from those inherited liabilities. The highest reward strategy involves taking the building out of office use entirely, converting it to residential apartments, lab space, or mixed use. Developers often secure local zoning approvals, map out the building code pathways, and assume the project is fully cleared to begin. A building can be perfectly zoned for residential use by the city, yet remain completely paralyzed by a restrictive use covenant recorded by the original developer decades ago. You also have to factor in reciprocal easement agreements, which govern how an entire block shares infrastructure, like plazas, loading docks, and central chiller plants. If a shared parking agreement from 1985 allocates spaces strictly by office headcount, that single provision can legally veto your transition to residential units. If the property is structured as an office condominium, changing its use usually requires amending a recorded declaration. That demands approval from other unit owners, partners you do not control. Municipal zoning gives you permission to build, but the recorded legal stock dictates whether you actually can. Buyers evaluating assets from Richmond through West Virginia must account for different closing architectures depending on which side of the state line the property sits. Virginia operates on a settlement agent model, where buyers are responsible for heavy state and local recordation taxes on both the deed and the new deed of trust. This matrix shows the breakdown of buyer closing costs for a standard $10 million financed purchase in both states. In Virginia, the combined state and local taxes on the deed and the trust will cost the buyer roughly $58,300, even before any regional add-on fees. West Virginia treats the closing as strictly attorney work. This mandates bringing local legal counsel onto the team from the very first week of the deal. However, West Virginia imposes zero value-based taxes on recording the deed and trust for the buyer. The burden shifts to the seller via a transfer excise, making the state highly favorable for financed buyers. Understanding these statutory defaults early allows you to negotiate allocations in the contract, protecting your equity basis before any capital is committed. In a repriced market, The physical building is subordinate to the legal rights recorded beneath it. This chart categorizes title elements by their potential to derail a business plan. Restrictive covenants and complex garage agreements sit firmly in the high-effort, high-impact quadrant. Operators who rely solely on pro forma spreadsheets and treat legal diligence as an afterthought will find their models crushed by these hidden constraints. Finally, there is the purely operational threat of the closing process itself, successfully moving the capital to the table. Business email compromise is a severe risk. Industry data shows that roughly 1 in 3 real estate transactions faces an attempted wire fraud. The only defense is strict process, without exceptions. Verify all instructions by phone with known contacts, and never accept payment changes via email, regardless of how urgent the request seems. Build your financial model around the recorded reality, and always clear the title before you clear the funds.
We are Virginia and West Virginia's premium title and escrow services provider.